Hey everyone, Andy here. I wanted to share with you all my thoughts about a illustration that I found, or that someone shared with me, that was found on Facebook. It's, as you'll see, it's an illustration comparing the past returns of an indexed strategy, most commonly that would have been used with what's called an indexed universal life insurance policy, versus the returns of the S&P 500. Now, this projection, this graphic, was from a group of a guy whose business is to sell indexed universal life insurance. Now, it's sold under different names. You may hear it or see it referred to as the Laser Fund, or a private reserve account, or a Section 7702 plan, or a tax-free retirement account, or a LIRP, LIRP, life insurance retirement plan. These are all just an indexed universal life insurance, which in a nutshell is uh, life insurance first and foremost, where every dollar amount of premium you pay, some of it goes to pay for the death benefit that you'll eventually get if and when you die, and some goes into uh, a cash value account. It's not technically an account 'cause it's not like it's yours and separated, but it's a cash value function within the policy. So pause that thought for a moment. I wanted to bring this up because there's lots of real misleading, in some cases deceptive, and I have to believe intentionally deceptive illustrations and sales pitches and claims made about a lot of these products. Oftentimes, a lot of them are around indexed universal life insurance products, or IULs. It's kind of been all the rage the last decade or so, largely because the stock market has been doing phenomenally well, and also because the volatility of the stock market has been low. Those two things really favor that. It's sort of the prime scenario for these indexed universal life insurance policies to do well. Now, there's headwinds going forward if equity markets don't do quite as well, or flatten out, or do poorly, and volatility of equity markets goes up. There's going to be a lot of disappointed policyholders that have these index universal life insurance policies. But stepping back, the slide I'm about to show again was a graphic shared by an index universal life insurance salesperson, really trying to drive home the value of indexing versus investing in a stock market, or some other risky asset itself. The claim you'll often see is share in the upside of the market with zero, guaranteed no loss, guaranteed zero downside. That's partially true. It's a half truth. It's a huge half truth, and I'll explain why. So the graph shows indexing. Now, what is indexing? Now, don't worry about the specific product for now. Indexing is simply the notion that you have something that's going to earn interest. The amount of interest that something earns is going to be somewhere between zero at a minimum, so no, not negative, or on the upside, it'll be some fraction or percentage or some amount referenced off of the return of some underlying index. Commonly, indexed products like indexed annuities or indexed universal life insurance will index the returns of the cash value portion of the policy off of the S&P 500, which is a stock market index that references the 500 largest stocks that trade on U.S. stock exchanges. There's lots of indexes that can be used, but that's one of the more common ones and one of the older ones used in these policies. So indexing is simply basically, if the market goes up, if the underlying index, the S&P 500 goes up, the policy will get some amount of interest greater than zero. It's not going to necessarily be the full amount of what the S&P got. It'll be some portion of it, typically what's called capped. So you'll get as much as the S&P gets, up to some cap. Beyond that cap, you don't get any more interest on your index product. You get capped out. But then on the downside, if the S&P is negative, you'll get zero interest for the year. You don't lose money in these products. So that much is true. The index interest credited will not be less than zero, or it'll be some positive amount if the underlying index goes up. But that part's true. What's glaringly misleading and half truth is that the amount of money you actually put into this policy doesn't all get invested, or at least it doesn't all go towards the cash value, because the product is first and foremost life insurance. So a large part of the money you put in goes to pay for the premium of the life insurance. There's also other policy costs that come out of your money, such that if you put $1 in, less than $1 actually goes into this cash accumulation feature. So not all of your money is getting invested in this indexing interest. So let me get into it, and this will all start to make more sense here. So I'll do a little screen share. So this is the image as shared in the group. And again, I have to believe the purpose of the post that had this image was simply to show, look how good this magical indexing interest earning process is. You'll never get less than zero. It's only going to be positive. Compare that versus something risky like the US stock market, where it can and will go down. And look how much better this indexing thing is. And guess what? You can get indexing if you buy an index universal life insurance policy. Again, half truth, and I'll explain more. So here's the graphic. Indexing strategies can generate growth potential based on the underlying index or indices you've chosen. That much is correct. Like I said, if the S&P 500 is the underlying index and it goes up whatever amount, you'll get some amount of positive interest. If the S&P goes down, you will get zero interest, meaning no loss. Which is this next sentence. The growth potential has a cap and a floor, otherwise known as a maximum or minimum. This means indexing credited to your account could potentially be higher than the traditional fixed interest funds. And you are also protected from negative earnings. So what this is saying, in traditional cash value or whole life insurance policies, your premiums go towards paying for the cost of the insurance, the death benefit, and the remainder of the premium after fees and such goes towards the cash value accumulation feature. In traditional whole life policies, which have been around much longer than in index universal life policies, the interest you get is some fixed rate, 3%, 4%, 5%, whatever it may be. It's mid-single digit percents, low to mid-single digit percents currently, depending on your policy, but it's a fixed interest. Whereas indexing, again, the mechanical difference is that instead of the interest on your cash value earning some fixed flat percent, like 3, 4, 5, 6% per year, the interest you get is based on the returns of some underlying index like the S&P 500. Again, you can get no less than zero interest any given year. If the S&P goes down or if the S&P goes up, you'll get some positive share of that. Cash value in these accounts may receive index credits based on a movement of an underlying index, but do not invest directly in the market. 100% correct. So even though the interest you get on your cash value within this policy is referenced off of the returns of the S&P 500, you are definitely not actually invested in the S&P 500. You do not own shares of the S&P 500 or a fund that seeks to mimic the S&P 500. You simply have kind of an IOU from the insurance company saying, if the S&P goes up X percent, I will pay you Y percent on your cash value accumulation within your policy. Performance is for illustrative purposes only. Great, good disclosure. Growth caps are subject to change over time as economic conditions may vary. This is a big one. This chart here is assuming starting in 1998. Where's the dates here? Why are there no dates? Why did it get cut off? I'm sorry, starting in 2001, going up through 2018. Now, this statement here is important. Growth caps are subject to change over time as economic conditions may vary. For example, I have a real life policy in front of me that someone bought in April 2010. It's from Minnesota Life. It is the Eclipse Index Life Policy. By looking at this does appear to have been set up for the intention to use it like one of these quote unquote tax-free retirement accounts, life insurance retirement plans, laser funds, or private reserve accounts. They're all the same thing, just different marketing names for index universal life insurance. When in this person's policy, the interest is credited based on the S&P 500. At the time the policy went in force, there was a cap of 16.5%. That cap dropped pretty soon after, and now the cap's only 10.5%. So what does that mean? So a cap is when if the S&P goes up, whatever percent it goes up, if you have a cap of 10.5%, or in this example, 12.5%, it means you will get every gain in the S&P up to a cap of 12.5%. So for example, the S&P goes up 5%, your cash value will get credited 5% interest. If the S&P goes up 10%, your cash value will get credited 10% interest. If the S&P goes up anything more than 12.5%, your cash value will get credited the cap of 12.5% interest. Whether the S&P goes up 13% or 35% or whatever, you'll get 12.5% interest. So you're capped on the upside, but the benefit is you're floored on the downside. Remember, if the S&P has a negative year, your policy will get zero interest for the year. You will not lose interest in your cash value accumulation. So I don't know why the dates weren't here. They were somewhere, but this started in 2001. Oh, it got cut off. What is this box here? Let me get rid of it. That's why. There we go. So starting 2001 through 2018. Now, this example assumed initial deposits of $400,000. It frankly doesn't matter the dollar amount, whether it's $1 or $1 million. It's functionally all the same lines and percentages. But they chose, let's assume you start with $400,000. So the example here is you put $400,000 in on day one against two different options. One is have it invested or have it purchase something that has this indexing feature, where hypothetically you would get a 12.5% cap on the S&P 500's annual returns. The other option was to instead put $400,000 into the actual S&P 500, where there is no, cap or floor. You simply get whatever the index would get, and that's the red line. So blue line again is this indexed, presumably indexed universal life is what they're getting at with this slide, and red is the S&P 500. So here's what would have happened if you had started at the beginning of 2001, again, with two different options of putting 400 grand into either one of these things. What would it look like at the end of 2018? Where $400,000 in this hypothetical indexed account that would have gotten a 12.5% cap on S&P returns would have ended up with $1.3 million, or an annualized average return of a little over 7%. Versus if you had put that money into the actual S&P 500, you would have only ended up with $759,000 with an average annual return of a little over 5%. So very compelling graphic. And if you look at this, it's wow, these indexing things put the S&P to shame. Yes, I can share in lots of the upside, no risk of downside loss. Why wouldn't I buy this? And that's largely the pitch. Hold that thought for now. I'll explain how this is a scenario that could have never happened because, well, I'll kind of jump to it. You can't put $400,000 into an index account today and have all $400,000 actually get this interest crediting. Again, because this is first and foremost a life insurance policy. So some portion of that 400,000 would have needed to go towards the premiums for the life insurance and the other policy costs. For example, that Minnesota life policy I referenced has the annual premium charge, an annual policy charge, and an annual, for the first 10 years at least, a policy issue charge on top of, there's additional fees for some riders that he has, but those fees didn't start yet. So there's fees that come out. So you can't actually invest if you have 400 grand, you can't put 400 grand into a life insurance policy and have it all get crediting interest from day one. Whereas you can actually put 400,000 into an investment product that seeks to replicate the S&P 500's returns. Anyway, so this graph, you see it on first sight. And if someone doesn't understand these products and how it works, this looks amazing. And it's a tremendously valuable sales tool to show this to folks. Now, not coincidentally, projections like this often start right around the peak of the tech boom in the late 90s, early 2000s. Because look, 2001, 2002 were bad years for the S&P 500. Now, frankly, I'm surprised they didn't start this projection in 2000, because 2000 was also a bad year for the S&P 500. It was down like 9-something%, I think. So if I was selling insurance, I would have started then to really cherry pick the most beneficial start date from purposes of comparing an indexed product where it would have had zero losses of interest versus the S&P, which would have 3 years of down losses. But anyway, they chose to start in 2001 for whatever reason and ended in 2018. I don't know why they didn't include 2019, 2020, 2021. My suspicion is because those were very strong years for the US stock market. So the projections won't look so good if you were to include those, but I did include them, and I'll show you what they would have looked like had you included them. Okay, so this is the very rosy looking projection. Here's just some tabular formats with the dollar amounts. Again, assuming you put 400 grand into each option, what would it have looked like at the end of 2018? And here you have it. Again, like I said, this isn't. This is for illustrative purposes only. You couldn't have actually possibly done this because you can't put 400 grand into a policy and have all 400,000 actually earn the interest crediting, because a portion of it goes to pay for the expenses of the life insurance you're actually buying. Whereas you can directly invest $400,000 into a product. You can't invest directly in the index, the S&P, but you can invest in a product that seeks to replicate the index, like an index mutual fund or index ETF, or something similar. And here's some other footnotes. Market returns assume S&P 500 annual returns for years 2001 to 2018, excluding dividends. That's a huge exclusion. And this is nothing short of intentionally being dishonest, in my opinion. Because, and I have a graph to explain why, these indexed returns of these insurance products only look at the returns of the S&P's change in price year to year. They do not look at the returns of the S&P's change in price and any dividends the S&P paid. Why is that important? If you actually invest in the S&P by way of an index mutual fund or some other indexed traditional investment product that invests in or seeks to replicate the S&P 500, not only do you get the returns of the S&P's change in price, you also get the dividends that the stocks in the S&P 500 throw off every year. And those add up, especially over decades. The historical average dividend yield of the S&P 500 over the last, roughly 20 years, 17 years, I guess, was approximately 2% per year. So right off the bat, this red line showing the S&P returns is lowballing by a substantial amount because it's showing the S&P returns excluding dividends. Well, if you invest in a product that seeks to replicate the S&P, you will get dividends. Yet this graph is choosing not to show that because it makes it much more compelling looking to compare the hypothetical index returns versus the actual S&P returns by just casually, I excluded the 2%, roughly 2% annual dividends you would have gotten every year if you invested in the S&P. But don't worry, I have a graph to show what this should look like if this were to be a more honest representation of this analysis. Here's another huge disclaimer. Indexed fund values do not include any cost. This is another thing that makes this analysis literally impossible to have ever played out. So I don't understand how this is allowed to be shown. Like I said before, you cannot, if you want to invest $400,000, you can directly invest $400,000 into a mutual fund or ETF, exchange traded fund, that seeks to replicate the S&P 500. And you will get returns substantially close to the S&P 500. There's going to be a small bit of slippage, anywhere from 0.02 to 0.05 percentage points per year. Your returns will be that much lower than the returns of the S&P because there's costs and transactions and fees associated with having a mutual fund or ETF. But the returns will track very close, again, other than that 0.02 to 0.05-ish percent difference that you'll get in actual returns of like an index fund versus hypothetical returns of the index itself. But the index strategy you're seeing here, like I said, you can't put $400,000 into it because there are costs. It's first and foremost life insurance. You will have to pay the premiums for the life insurance, and you have to pay the other policy costs. Again, this Minnesota life policy, premium charges, policy issuance charges. Those will all come out of your $400,000. So another huge kind of glossed over footnote that really would completely change the trajectory of what these two lines look like. So at best, in my opinion, people who use these or graphics like these to kind of demonstrate the potential value of index universal life insurance, at best, they just simply don't understand what they're selling. They don't know that these really large caveats kind of need to be reflected and not just relegated to footnotes. At worst, it's intentionally deceptive. I'll give the benefit of the doubt, and I'll assume that's not the case. I'll assume people just don't understand this stuff when they're selling it and showing these projections. But it really makes you wonder. And finally, this last one is obvious disclaimer, which should be here, and I'm glad it is. Hypothetical examples for illustrative purposes only. This is not a prediction or guarantee of actual results, which will vary from those described. Largely for the reasons I mentioned, this scenario cannot actually have ever happened because it's simply not possible due to the fees of the policy. All right, so that's the graphic. I want to walk you through what this is doing. So again, you look at this at first glance, like, wow, this is amazing. Sign me up for this magical index product, right? Because look how much better it would have been. Yeah, again, cherry picked to start at the top of the tech bubble, and some of this data is just flat out wrong. And I'll show you. I'll jump to that now. Some of these figures they over exaggerated these returns. So let's get to it. Here are here's the price return of the S&P 500. Remember, I said these index products, the interest rate credit is based off the price return of the S&P 500, not the total return. The total return is price return plus the amount of dividends paid out each year. So total return will always be higher than price return, but they use the lower price return for indexing these products, which it's all insurance products do that. It is what it is. So this is, again, assuming a 12.5% cap on the indexing, meaning whatever the S&P goes up, you'll get that much, but capped at 12.5%. or if the S&P goes down, you'll get 0 credited to your cash value. So here's the years 2001 to 2018. Here's what the S&P's price return actually was for each of those years. And these jive. The amounts shown on this graph, these price returns shown for the S&P are accurate. I did confirm these. You can Google this. You can find S&P returns on multiple reputable sources online. Just do some quick Googling. So these are the S&P's price returns, again, excluding dividends. If you included dividends, they'd all be higher. But these are the price returns. Now, here's the index returns, the blue line, again, on that chart. Here's the index returns depicted on that chart. Now, recall the index returns will be, if the S&P is negative, the index returns will be 0. If the S&P is positive, the index returns will be equal to the S&P's return, but capped at 12.5%. So now, here's what was depicted in the graph for the index returns, but some of these are wrong. They overstated a few of them and understated one of them, oddly. I'll assume that's just sloppiness on their part. I can understand them overstating, again, trying to kind of fluff up their projections, but understating is just whoever made that chart, it was sloppy. Here's what the correct hypothetical past index returns should have been. Here's the years where there are differences. So for example, 2004, the S&P's price return was 8.99%. The index returns could not have been more than 8.99%. They'll top out whatever the S&P was. So the chart was showing the index got 9% return when it should have only gotten 8.99. Not a tremendous difference. We'll just chalk this up to rounding error, give the benefit of the doubt. But nonetheless, the shown index return was 0.01% higher than it should have been. 2005, very different story, much worse. The S&P's price return is only 3.00%. Yet the blue graph depicted a index return of 4.7%. Couldn't have happened. You wouldn't have gotten more than 3% because that's what the S&P got. So the index should have shown a return of 3% for that year, which means the blue line fluffed up this year's return by 1.7%. Not a dramatic difference, but still makes you wonder. Clearly something was wrong, and sloppiness in whoever made this chart. Sloppiness at best, underhandedness at worst. And then 2006, everything was fine. So S&P returned more than 12.5%, which means the index would have capped out at 12.5 as it did. So it showed the right number. 2007, they messed up in their projections. S&P returned 3.53%. They only showed 2.43 for the index. They should have shown 3.53 because, again, the index will get the index product will earn as much as the S&P, capped at 12.5%. So they shortchanged themselves by 1.1%. And then there's 2 other years where they, again, overstated the index's returns based on what they should have been when looking at the actual S&P returns. So all said and done, not a tremendous difference, but all said and done over 2001 and 2018, the index returns shown in the graph were higher by about 3% than they should have been. Again, I'll just assume that's operational sloppiness. I'll give the benefit of the doubt, and let's hope it wasn't intentional deception or fluffing up, padding of the numbers. So now, here's the original, just to show graphically what this would have been, the hypothetical historical index returns as shown on that original graphic that was someone shared with me from the Facebook group. Here's what the line was. Now, I'm not showing the dollar amounts. Again, the dollar amounts don't matter. Whether you start at 400,000 or $1 or $1 million, doesn't matter. Let's pay attention to the percentages because it's all the same math. So here's the total percentage returns. As shown in the original graphic, the index would have returned 332% from the start of 2001 to the end of 2018. And here's all the annual index crediting rates that were shown in the original graphic. But remember, like I said, some of those were wrong. They overstated and understated some of them. This dark blue line, not the dashed line, this is what the actual, this is all hypothetical, but this is what the correct hypothetical index return should have been after I adjusted for the incorrect interest crediting that they showed in the original graph. So again, this was the year that they showed 9% index return. It should have only been 8.99 for the index product. The following year, they showed 4.7, should have only been 3. This was the year they shot too low. They only showed 2.43, should have been 3.53. But anyway, you drag this out over the course of this full projection, and the final return of the index product should have only been 323%, not 332. So not a huge difference again, but clearly someone was either sloppy or intentionally overstated the figures a little bit. Okay, so that's just wanted to correct the indexed returns because they were wrong, flat out wrong to start with. Now let's look at the S&P returns. Recall I said that the indexed products, like index universal life insurance or index annuities, only look at the price return of the S&P. They do not look at the total return of the S&P. And total return is simply price return plus the dividends you'd actually get if you invested in a product that invested in the S&P. So that red line that was shown was as the sort of comparison, the investment alternative you could have had other than investing in this indexed product. The red line showed only the S&P's price returns. But again, if you invest in something, an S&P index fund, for example, mutual fund or ETF, you don't get just the price returns, you get the annual dividends that are paid off every year as well. And those have been averaging about 2% over this time period. So here are the S&P's price returns, the change in price from beginning of the year to end of the year for 2001 to 2018. And again, this is what was graphed on that red bar in that original graphic. But here were the total returns. The total returns were better every year by roughly 2% on average. Again, the difference is in addition to the change in price, you also get the dividends if you're actually investing in a product that invests in the S&P companies. So these were the total returns that someone would have realized had they invested in an S&P index mutual fund or something versus the hypothetical returns shown in that red line that excluded dividends, which is a huge exclusion, and in my opinion, intentionally deceptive to do that. So just to show you, here's the difference. The returns shown for the red S&P line in the original graphic, how much lower they were than what someone would have actually gotten had they invested in an S&P 500 product because they would have received dividends. This is how much each year was shortchanged. So in 2001, for example, the original graphic showed a return that was about 1.15% lower than what someone would have actually gotten the S&P because they would have gotten dividends. Some years were higher, 2.3%, 2.17. 2009, off by a lot, 3% lower. Let's just say on average, roughly 2% per year. Your returns to the S&P would have been better about 2% per year versus what was shown in that graph. So here was the original chart of what the sales graphic showed. This was that red line at the bottom. Again, I'm not showing in dollar amounts. Dollars don't matter. Let's just look at the percentage amounts. These will apply to any dollar amount you want to throw in. But had you invested 400 grand in the S&P 500 at the beginning of 2001, the original graph was saying you would have only gotten 190% return over the course of this, through 2018. So the first few years of the S&P were down. 2001, 2002 were down years, and then good years, and then the 08 global financial crisis happened, and then recovered some, and 2018 was down, et cetera. So this was the original graph of the S&P. But like I said, had you actually invested in an S&P product like an S&P index mutual fund, this isn't what you would have gotten. Okay, you would have gotten this dark red line, because you would have gotten dividends along the way. And insurance projections like the one we saw, choose to exclude the fact that if you actually invested in the S&P, you would have gotten dividends. It makes their graph much less compelling if they were to show the dividends included. So this dark red line, this dotted line is what was originally shown in the projection, the sales projection. The dark red line is what would have actually happened had you invested in an S&P product like an S&P mutual fund. But actually, to be fair, like I mentioned before, the actual returns will be slightly lower because every year's return would have been 0.02 to 0.05-ish% lower, because you can't directly invest in an index. An index is just a hypothetical reference. To invest in an index, you have to invest by way of like an exchange traded fund or a mutual fund that seeks to replicate the index. And those funds have some costs associated to them, such that those costs will reduce your returns from what the hypothetical index return would have been. So the actual bar will be slightly lower by, let's just call it 0.05 percentage points. Let's even be generous, 0.01, 1% point or whatever. But point is, the originally shown graph showed the S&P would have only returned 190% over these 17 years. In actuality, because you would have gotten dividends, you would have gotten 271%. Dramatically different story, right? So let's go back and look at the original chart. This is what the original chart would have shown. The hypothetical indexed returns you would have gotten with the 12.5% cap from 2001 to 2018 would have been this blue line. The red line shows the hypothetical returns someone would have gotten had they only gotten S&P 500 price returns. These dark lines, this is the accurate, this is the honest, accurate depiction of what that chart should have looked like. The dark blue line, again, is the corrected index returns, because recall there were a few years where they inflated. Let's assume mistakenly inflated the index returns. So this is dark blue line is what they would have actually would have been. The dark red line is what the S&P total returns would have been if you actually invested in the S&P, because you would have gotten dividends. Look how much difference. This is why dividends matter. Had you not, assume you don't get dividends like that fake projection showed, you would have gotten 190% return on your S&P investment. You would have actually gotten dividends. So you would have actually gotten 271% return. Huge difference, right? Now, still below what the hypothetical index return would have been. Completely acknowledge that. But like I said, the scenario could not have actually played out. If you were to put 400,000, 100,000, whatever, to invest at the beginning of 2001, you could have invested all 100,000 into an S&P index mutual fund, and you would have gotten this. Well, slightly less than this, like I said, because of the annual 0.02 to 0.05% fees that would have come out of your mutual fund or ETF. So your returns would have been, I don't know, somewhere around here. Let's just call it 270, high 260%. Versus the index, you couldn't have put all 400,000 or 100,000 in here. So your actual returns, the interest credited to your cash would have been this, but your actual dollar amount of returns would have been substantially less than this, because not all 100,000 or 400,000 would have actually gotten this interest because of the fees of the policy, the cost of the policy, because it is life insurance. Life insurance has a cost. All right, so I just wanted to show, take these projections with a grain of salt. Not only do they sometimes have just flat out inaccurate info, like I showed with the index returns, but they're also tremendously misleading at times. Like it's completely unfair to say this is what you would have gotten if you invested in the S&P. No, you wouldn't. You would have gotten this or something close to this, right? That's the difference. Now, like I said, I've seen various iterations of this type of projection from Index Universal Life Insurance salespeople multiple times, and not coincidentally, they all sort of start in 2000 and 2001, because that's when coming off the peak of the tech bubble, U.S. stock market had a horrible 2 or 3 years or 3 years after that. So yes, they start these projections, these comparisons right then to show, look, S&P went down, down, down the first few years. Well, you lost nothing in this indexed strategy. So great starting point. What if, hypothetically, we would have gone back to 1997? So the first indexed universal life insurance policy was issued in 1997 by Transamerica. Another side note, anyone who pretends to show you indexed universal life insurance results or hypothetical results prior to 1997 is completely making up data. The product literally did not exist until 1997. So if anyone claims to show you real data, real analysis, real numbers, no, it's all just hypothetical back testing of what could have possibly been. But again, the product did not exist until 1997. So what if we were to have started this analysis in 1997 as opposed to the peak of the tech bubble? Let's start when Index Universal Life Insurance first came to the market. Here's what things would look like. Blue line, again, is what the hypothetical indexed returns would have been of the policy, whereas red is the S&P 500 total returns. So had you put X amount of dollars into the S&P 500 index tracking mutual fund at the beginning of 1997, this red line is how much return you would have had through 2018. You would have made roughly 512% on your money. But again, to be fair, this should be slightly lower because there would have been a little bit of fee drag because you'd be investing in a mutual fund or something. So maybe it's 510% or whatever, but still it's going to be well over 500%. Versus the indexed hypothetical interest would have been this. It would have returned 461%. So now doesn't look so great anymore, right? S&P did better than the next return. So that's why these projections don't show you typically back to 1997, because the stock market had a few good years. So let's exclude that. Let's start right when the stock market started to have a few bad years. That's what happens with these projections. But again, I have to reiterate, this is also a bad bogus projection, because these two things could have never happened. Yes, you could have actually invested in the S&P 500 total return tracking mutual fund, but you could not have actually put 100% of your money into an insurance policy that would have actually gotten interest on 100% of your money like this, because of the policy fees you have to pay. So even if you could, hypothetically, the S&P still would have been better. Now, whereas I don't know why. Okay, I actually do know why. So let's go back to another assumption. The sales pitch shown from the Facebook group started in 2001. Again, not coincidentally, because that's when the tech bust was happening. So it looks favorable for these indexed universal life insurance products. But they stopped at 2018. What if you carried this analysis through from 2001 all the way through to the end of 2021? Here's what things would have looked like. S&P had a phenomenally, freakishly strong last few years, 2019, 2020, 2021. I don't know why the insurance projection didn't include them. I'll give the benefit of the doubt and assume that was an old graphic that was made at the end of 2018. But if they want to be more fair and accurate, they really should have updated it through the last 3 years that have since happened. And this is what things would have looked like. The S&P would have returned 543%, inclusive of dividends. The hypothetical indexed universal life interest crediting would have returned 461%. Now, here we are, early 2022. As I'm making this, S&P is down not quite 10% as of today. So this would have come down some. I don't know roughly where, but let's just assume it comes down to here-ish. Still over 500%, whereas the index is 461%. All right, that's about it. I just put a lot of time into making these graphs and analyzing and validating the data just to really show. You always have to take these projections with a grain of salt. Let me take off my screen share here. You always have to take these projections with a grain of salt. There's, in some cases, just flat out inaccurate bad data. We'll assume that's just operational mistake, but there is lots of massaging and the choice to exclude the impact of dividends in the S&P return. I have to assume wasn't mistaken. That was probably intentional and part of the projection to make the disparity between how high the index universal life return would have been versus the S&P to make that disparity that much larger. But when you add dividends, like I showed, that disparity collapsed pretty quick or got much substantially smaller. And you can't actually invest. The other big takeaway, you can't put $400,000 into one of these policies and have all $400,000 immediately start earning this interest. There will be these fees. Like I said, this Minnesota life policy, premium charge, policy issue charge, all for the first 10 years. And this person's actual policy, I won't show it because there is sensitive info on it. Again, started April 2010. At the time, it had a 16.5% cap on the S&P. Super juicy, right? Well, that cap came down pretty quickly. So the cap's usually committed for a year. That first year of the policy, yes, he got 16.5% cap in 2010. But then typically what happens with these policies is the caps come down in subsequent years. Part of it is kind of, I don't say a teaser rate, but they'll offer high caps to new policyholders to kind of entice them to get them in. And then not coincidentally, over time, the caps typically come down. And they start offering the higher caps to the new policyholders to kind of get them in the door with these kind of in effect teaser rates. Now, one of the real disservice is insurance companies don't have to show you their history of how they change caps. So like this policyholder, his policy started at 16.5% cap. He's now getting 10.5% cap. And if Minnesota Life were to market a policy today, they wouldn't have to say or disclaim or disclose that, in 2010, this same product originally had a 16.5% cap. They don't have to do that, unfortunately. So people who buy this don't know the history of how caps could move. And like I said before, Index Universal Life has kind of had its heyday over the last 10 years, given the combination of really strong stock market returns and fairly low volatility of stock market. Those two things do well for the caps and the interest credited in Index Universal Life policies. Now going forward, we're at, we're slightly down from the high, but we're at a peak of what's been a tremendously high stock market run up. A lot of people assume stocks have to come down or at least stall out for a while. So that right there wouldn't bode well for the interest that's going to be credited to these policies going forward, if you do in fact assume stocks will go down or stay flat. But also the volatility, stock market volatility doesn't do well for these caps. All else equal, the higher the volatility is in the stock market, the lower these caps will be. For technical reasons outside the scope of this, it's because how the insurance companies buy options on the underlying index to give you the crediting in these things. But anyway, I'll leave that there. So that's it for now. I'll stop. There's much more I can say. I plan on doing other videos about this, but I thought this was important because someone shared this projection with me, found it on Facebook, and I was like, wow, I have to discuss this because this is just so glaringly misleading, with just outright incorrect information in some of it. So that's that. Hope you liked it. Take care. I'll see you next time.